Hello there. In this video, we'll demonstrate the solution to in-class problem 3.1 on cost volume profit analysis. The nice thing about this particular problem is it brings together all the concepts we've covered as part of CVP, including break-even quantity, earning a pre-tax profit, earning a target post-tax or after-tax profit, the degree of operating leverage, and margin of safety. So here's the nature of our problem. Russell manufactures a particular item. The revenue per unit is $2.50. The variable manufacturing cost is 75 cents. Variable selling and distribution costs are another 5 cents per unit. And then fixed manufacturing and selling and admin are $250,000 and $90,000 respectively. So the fixed manufacturing is $250,000 and then the fixed selling and admin is the $90,000. So we'll proceed with our first requirement, which is to determine the break-even quantity in units. Remember we said our break-even point, which I like to call Q star, is equal to, and we're going to use a shortcut solution, or shortcut formula, is fixed costs over the unit contribution margin. Well, we know that the fixed costs are $250,000 for the fixed manufacturing overhead, plus another $90,000 for the fixed selling and admin costs. And we're going to divide that by the contribution margin, but we want to calculate the contribution margin to be the $2.50 unit selling price minus the 0.75 unit variable cost minus the 0.05 unit variable selling and admin costs. And so all of that equals $1.70. 250 minus 80 is $1.70. So divided by 1.70 in unit contribution margin, that will give you $340,000 in total fixed costs, divided by 1.70 equals 200,000 units. And that's the break-even point. If you're not sure, always plug it back into the equation to make sure that you end up with a profit of 0. Okay, next we'll look at determining the second requirement, which is how much revenue do we need to earn for a pre-tax profit? For number 2, we want revenue. So we're going to determine the desired revenue, Q dollars, to be the fixed cost plus what I call a target operating income, right? So this pre-tax profit of $200,000 is actually the desired target operating income. And we treat that basically as an addition to the fixed cost on the top line. And we'll take that, we'll divide by the contribution margin percentage or contribution margin ratio. That'll get us straight to the dollars. Well, we know from the work we did up here that the fixed costs are $340,000, but now we're going to add the $200,000 target operating income. And we're going to divide that by some contribution margin percentage. And recall from the work that we did that the contribution margin ratio is the contribution margin, we could do this on a per unit basis, divided by the unit selling price. We've already determined that the unit contribution margin is $1.70, and we know that the selling price is $2.50, so that gives us a contribution margin percentage of 68%. And so we would then plunk that into our denominator here. I'll put 0.68, so it's at a decimal, and that will give us desired revenues to achieve that of $794,118. So that's what you need to earn a target operating income before tax of $200,000. All right, our next requirement, number 3, is to look at determining a post-tax or after-tax net income, which in our previous lessons I referred to as a TNI, target net income. And the company has a corporate tax rate of 30%, and we're looking for a TNI of $100,000. To solve this one, again, we're looking for some revenue quantity, and that's going to be equal to fixed costs plus our target operating income, but we determine our target operating income as the target net income divided by 1 minus the tax rate. And we're going to divide that by the same contribution margin percentage because we're still looking at the revenue required. We know from the work we've done already that our fixed costs are $340,000, but now on our numerator we want $100,000 in target net income, and I'm going to divide by 1 minus 0.30, which is the tax rate, and we're going to divide all of that by the contribution margin percentage of 0.68. This then changes our numerator to 340,000 total fixed costs plus 142,857, and that is the result of this piece right here, 142,857. And we'll divide all of that by 0.68, which is the contribution margin percentage, and that will give us revenue of 710,084 in total revenue required to achieve an after-tax profit of $100,000 with a tax rate of 30%. Our next requirement, number 4, is to calculate the degree of operating leverage, which we like to call the DOL, assuming that the company has a sales level of $700,000. Our formula for DOL is equal to contribution margin divided by operating income. And we can calculate our contribution margin by taking the $700,000 in sales and we multiply by the 68% contribution margin ratio. You see, I don't have to recalculate or redo an entire income statement to solve this problem. If I know my contribution margin ratio, then I multiply that by sales and I'll get my contribution margin. And then I need to divide that by some operating income, which we don't know yet. Now, this will result in a contribution margin of $476,000. And then if I subtract my fixed costs of $340,000, I'll end up with operating income of $136,000. So now I can complete my degree of operating leverage calculation to be $476,000 in contribution margin divided by $136,000 in operating income, and that will be a multiple of 3.50. And so that means that for every 1% increase in sales, we'll have a 3.5% increase in operating income. And so if that's a 10% increase in sales, then it's a 35% increase in operating income. Our last requirement, number 5, is to use the margin of safety, in this case the MOS, given at 20% to determine what level of sales units management needs. So if we know that from the work that we talked about in class, that the margin of safety is equal to actual or estimated sales, and this could be in units or dollars, minus the break-even sales. And from that, we know that the margin of safety percentage is equal to the margin of safety divided by the estimated sales, and we're going to use the estimated sales because this is what we're being asked for in this question, what the estimated sales are. Since we know that 0.2 or 20% is equal to X, we'll call the estimated sales X, which is what we don't know, minus the 200,000 break-even sales that we already calculated, divided by X. Right? So we have the estimated sales in both the numerator and the denominator. So then 0.2x is equal to x minus 200,000. And so using basic algebra, we will determine that 200,000 must be equal to 0.8x. And so x, or the estimated sales, is going to be 200,000 div 0.8, or 250,000 units. And so the estimated sales level is 250,000 units. And if you're not quite sure, let's do a quick proof. If 250,000 estimated sales minus 200,000 break even gives you a 50,000 margin of safety, and we divide that by 250,000 expected sales, well, isn't that going to be 20%? And that's it. So we're now finished in class problem 3.1 on cost volume profit analysis.